Most people spend months negotiating the best price for their home. They fight for every dollar on the sale. And then they hand thousands of those dollars right back. Not to the IRS, but to Medicare. And they never see it coming. Here's what they don't know. That profit doesn't just trigger capital gains tax. It triggers something called IRMAA. IRMAA, the Income-Related Monthly Adjustment Amount. That's Medicare's way of saying you made too much money, so now your healthcare costs are going up, and by a lot. And the really cruel part, you won't even know it happened until 2 years later. A letter from Social Security arrives and tells you your Medicare premium just jumped by hundreds of dollars a month. A letter that says you could owe up to $13,872 more per year if you're married. That's according to the CMS 2026 guidelines just released last November. A letter you can't appeal because you did nothing wrong. You just sold your house at the wrong time. That can be a very expensive mistake. All right, let's start with what IRMAA actually is, because most people have never even heard the word. IRMAA stands for Income-Related Monthly Adjustment Amount. It's a surcharge on top of your standard Medicare Part B and Part D premiums, and it kicks in when your modified adjusted gross income crosses a certain threshold. Now, here's where it gets dangerous from homeowners. Medicare doesn't just look at your income from this year, they look at your tax return from 2 years ago. So if you sell your home in 2026, the capital gain shows up on your 2026 tax return. Medicare looks at that return in 2028. And suddenly your premiums spike for the entire year. You've already spent the profit. You've already moved into the smaller place. And now the Medicare sends you a bill that you never budgeted for. And let me say this clearly. This is not some obscure rule that affects a handful of people. About 8% of Medicare beneficiaries pay IRMAA. That's millions of Americans. And home sales are one of the most common triggers because a big one-time capital gain can push you over the threshold, even if your normal income is modest. So you have to do the full math, not the hopeful math, but you got to do the real math. What you'll actually pay. Let me show you exactly what we're talking about. These are the 2026 IRMAA brackets from CMS. The standard Medicare Part B premium in 2026 is $202.90 a month. That's what most people pay. If you're single and your modified adjusted gross income is $109,000 or less, no surcharge, you pay the standard premium. Same for married couples under $218,000 a year. But watch what happens when you cross that line. Coming in at the first tier, if your income is between $109,000 and $137,000 as a single person, your Part B premium jumps from $202.90 to $284.10. That's an extra $81.20 per month, $974.40 a year. Now, that first tier, not that scary, right? But here's the thing, selling a home doesn't push you into the first tier. It often launches you right through several tiers at once. Let's say you bought your home in 1995 for $200,000. Today it's worth $700,000. That's a $500,000 gain. Even after the $250,000 Section 121 exclusion if you're single, which we'll get into, you're still at $250,000 capital gain, hitting your tax return. That could push your MAGI from $80,000 to $330,000 in a single year. At $330,000, you're in the fourth IRMAA tier. Your Part B premium goes from $202.90 to $527.50 a month. That's $324 extra per month, every single month. Almost $4,000 more per year on Part B. And if your gain pushes you above $500,000, you're paying an extra $689 a month. That's $487 in surcharges, almost $6,000 extra per year for one person on Part B alone. This is not a small decision. This can have a major impact on your retirement. But we're not done because IRMAA doesn't just hit Part B, it also hits Part D, your prescription drug coverage. Same income brackets, additional surcharges. At that fourth tier I just described, $330,000 MAGI, your Part D surcharge is $60.40 per month. That's on top of whatever your plan already costs. At the top tier, above $500,000 for singles, the Part D surcharge is $91 per month, $1,092 a year. So let me put it all together for you. Single person, top IRMAA tier, $487 Part B surcharge, plus $91 Part D surcharge. That's $578 per month extra. $6,936 per year in surprise Medicare costs triggered by selling your own home. Now, if you're married, double it. Your spouse pays the same surcharges, you're looking at up to $13,872 a year in additional Medicare premiums caused by one home sale. You need to know this information and know these numbers so you can make your own decision with your eyes wide open and not get blindsided like so many people do. So now you're probably thinking, okay, Chris, this sounds terrible. Is there anything I can do about it? Well, yes, and that's exactly what we're covering next. Your Section 121 exclusion is your first line of defense. The IRS gives homeowners a powerful tool called Section 121 exclusion. If you've owned and lived in your home for at least 2 of the last 5 years, you can exclude up to $250,000 of capital gains if you're single, or $500,000 if you're married filing jointly. This is huge. In my 25 years of helping people navigate home sales, this exclusion has saved my clients hundreds of thousands of dollars. But, and this is a big but, the Section 121 exclusion hasn't been adjusted for inflation at all. The $250,000 and the $500,000 limits were set in 1997. That's almost 30 years ago. In 1997, the median home price in America was about $146,000. Today, it's north of $400,000. In high-cost markets like California, New York, parts of Utah, you could easily have a gain of $600,000, $700,000 or even more. That exclusion doesn't fully cover you anymore. And here's the thing most people don't think about. You can also increase your cost basis. Any major capital improvements you've made over the years, a new roof, an addition, a kitchen remodel, those get added to your purchase price, which reduces your taxable gain. Make sure you keep those receipts. And here's a little tip. They don't often look deeply and thoroughly into all of those numbers. Not telling you to cheat. Make sure you keep your receipts. But list everything on there. But even with the exclusion and a stepped up basis, a lot of people still end up with a 6-figure capital gain on their tax return. And that gain, it counts as income for IRMAA purposes. So what do you do if you're sitting on a home with a huge gain and you need to sell? How do you avoid getting hammered by IRMAA 2 years later? That's where planning comes in, and most people don't do it. I'm going to give you 3 strategies. None of them are complicated, but almost nobody uses them because nobody tells you about them. Strategy number 1, time the sale. Remember the 2-year look back? If you sell in 2026, IRMAA hits in 2028. But IRMAA is calculated fresh every year based on your tax return from 2 years prior. So in 2029, Medicare looks at your 2027 return. If your 2027 income is back to normal, no home sale, your IRMAA surcharge drops off. The key is knowing that the pain is temporary, but you have to plan for it. You can't be surprised by it. Strategy number 2, spread the gain. There are legal ways to avoid taking the entire gain in 1 year. Installment sales, certain trust structures, timing the closing date relative to other income events. A quick disclaimer, I'm a real estate broker, not a CPA or a tax attorney. You need to sit down with a qualified tax professional before you make any moves. But I can tell you from 25 years of watching these transactions that the people who plan ahead save dramatically more than those who don't. Strategy number 3, use my retirement state cost calculator. It's free and I have it linked right down below. So here's what I built. I built something that nobody else has. Most people plan their retirement move around one number, the sale price. But that's the wrong number. My calculator factors in the full financial picture, the home sale, the capital gains, the IRMAA impact, the new state's tax burdens, property taxes, everything. So before you even list your home, you can see exactly what your Medicare premiums will look like 2 years out, and you can plan around it. There's a link below where you can access the calculator. It's all free. You don't have to put in your email address or anything like that. But don't choose a retirement strategy based on one headline. And do not stay in a high-cost home just because selling is complicated. Make sure you get the full picture first. Let me tell you about a couple I worked with recently. We'll call them Bill and Susan. Bill and Susan bought their home in Salt Lake County in 1998. They paid $210,000 for it. Today, it's worth about $850,000. They're ready to downsize. The kids are gone. The yard is too much work, and they want to free up some cash for travel. On paper, they're looking at $640,000 gain, filing jointly, so the $500,000 exclusion covers most of it, but they'd still have $140,000 in taxable gains. Their normal income, Social Security plus IRA withdrawals, is about $95,000 a year. Add $140,000 capital gains, and suddenly they're at $235,000 MAGI in the year they sell. That pushes them from the standard $202.90 Part B premium to $284.10 each, plus Part D surcharges combined. They'd pay about $2,500 extra in Medicare premiums in 2028. Now, $2,500 isn't almost $14,000, but it's $2,500 they didn't budget for. And for a lot of retirees living on a fixed income, that's real money. Here's what we did. Bill and Susan used the calculator to model their sale timing. They realized that if they sold in a year when their other income was a little lower, fewer IRA withdrawals, maybe delayed Social Security for one spouse, they could keep their MAGI under $218,000 and avoid the IRMAA entirely. They made their own decision with their eyes wide open, and that's the whole point. So here's the bottom line. Selling your home is probably the biggest single financial transaction of your retirement. The sale price matters, the capital gains tax matters, but the IRMAA impact, the Medicare surcharge that kicks in 2 years later, that's the one almost nobody thinks about until the letter shows up and they're totally blindsided. I've seen people focus on the wrong thing, move with bad assumptions, and then realize much too late that their monthly costs are nothing like what they expected, and now they're stuck. Don't let that be you. The Retirement Estate Cost Calculator is linked below. It's free. You don't have to give me any of your information to use it. It factors in everything: taxes, IRMAA, property costs, the full picture. Use it before you list. Use it before you decide where to go. You can also book a free call with me. The link is in the description. I'll share everything I've gathered and learned over the last 25 years of helping people make this exact transition. So please do me a favor, hit that like and subscribe button if you're getting any information, or if this information I'm giving you is helpful. Let me know in the comments, had you ever heard of IRMAA before this video? What state are you in right now? And where do you plan to move to? And if you have questions about which states have the best taxes and which ones might be the best move to, you can watch this next video right here. So thanks for joining me today. And until the next time, please stay safe, my friends.